As a pioneer investing with ETFs over 15 years, we offer 15 portfolios in 3 different strategies: global multi-asset standard portfolios, multi-asset tax-sense portfolios, and multi-asset income portfolios, as well as high net worth solutions. So last year, we launched the first ever 6 global indices, ranging from the most conservative 2080 index, NFGII, to the most aggressive All Equity Index, NFGEI. The global indices are constructed in exactly the same way as our global standard ETF strategies. The indices are calculated and verified by S&P Dow Jones. As people are familiar with this, that we like to start performance with the review of those indices, as they are the most transparent representatives of our investment process, provided in real time. And this is an example of our indices reacting to news in real time. On October 6th, markets were initially optimistic that a bipartisan plan for a second round of economic stimulus would be quickly passed. So when a presidential tweet at 2:48 in the afternoon announced that there would be no deal, markets reacted negatively. I'd like to note here that this is not political, but just a good example of surprise news. In stock markets, much comes down to expectations. We don't want to focus on the negative news, but it's well understood that markets react more strongly and quickly to negative news than positive news. Look at how 6 real-time indices reacted to this event. Right after the tweet, our global equity index dropped 1.48%, and our global institutional index and the GBI fell 0.68%. And yes, you can always check the index performance during the day anytime in your phone or by your smartwatch to capture this dynamic of the market. Despite of those surprises, market continued their upward momentum in the 3rd quarter, with all our indices reached all-time high on September 2nd, bringing the year-to-date return back to positive territory, indicated by green bar for our indices and yellow for blended benchmark in the chart. New Frontier Global Institutional Index and the GBI with 60/40 stock-bond ratio posted 4.2% for the year. Except for our aggressive index being pretty much in line with the benchmark, our indices outperformed the benchmarks for this quarter and for this year. Remarkably, our less aggressive index, like 40/60, has performed exceptionally well compared to the benchmark, as well as compared to 40/60 peers in the market. For this quarter, high yield exposure continued to add to relative return within our fixed income sleeves. For this year, broad overweight exposure to long duration treasuries, gold, and China greatly contributed to the outperformance. Overweight allocation to small cap, on the other hand, detracted from performance. What is something new here is that we also launched 2 new Frontier US indices last year, which are constructed with the same investment process and the same technology as our global indices, but are designed for US investors with dollar-denominated liabilities. 4 more US indices that target at 2080, 40/60, 75/25, 90/10 stock-bond ratio will come soon. And as US markets continued to dominate the rest of the world in 2020, our US index powered higher for a new record in September. New Frontier US Institutional Index and the DBI posted 4.6% both for the quarter and for the year. New Frontier US Equity Index and the NFDEI was up 5.8% for the year. Now let's move on to our tax-sense portfolios. What we have here in the chart is our net of fee composite performance for this quarter and year to date. Tax-sensitive in general have performed consistently in line with our standard portfolios, with great performance both in absolute terms and relative terms against their benchmarks. Drilling down, municipal bonds in general underperformed treasuries for the year, and despite of a rebound in the 2nd quarter from March sell-off, which explains some of the difference in returns compared to standard portfolios for less aggressive profiles. And in terms of multi-asset income portfolios, looking at net of fee composite performance in the chart, high dividends were slowly recovering during the third quarter, but the scope of the bounce back from the March sell-off remains modest. So compared with numbers we saw earlier with tech-sensitive portfolios, multi-asset income portfolios did not see a dramatic rebound due to low exposure to growth stocks. In the relative terms, multi-asset income portfolios outperformed the benchmark by roughly 1% for the quarter and 2 to 4% for the year. Overweighting in long treasuries and preferreds contributed to the outperformance. Again, it's important to remember here that multi-asset income portfolios are constructed to be income-oriented, and it has been doing a good job in tracking its investment objective. Especially in this low interest rate environment, we are providing consistent and stable yield, which is around 4% here. So now let's take a look at our assets we invest in. First, on the fixed income side. It was a quiet quarter for bonds, with interest rates likely locked at low levels for extended period of time. From Q3 column on the left, we can see treasuries were flat for the quarter as yields were barely changed from the last quarter. The Federal Reserve's policy shift towards greater flexibility on inflation led to a weaker dollar that boosted the performance of international treasuries. US TIPS posted a strong quarter as investors hedged against the higher potential for inflation. Riskier bonds like high yield were leading the quarter as investors seeking out high yields. For the year, bonds are ahead of US equities. Ag gained 6%, which is more than what S&P and ACRI gained in 2020. So looking at the chart on the right, you would see high yield in the yellow line has made up most of the lost ground since March sell-off and was back where it started the year. Investment grade corporate bond experienced a stronger rebound supported by Fed's credit facility, bringing its year-to-date performance into green with the 7% gain. As people will refer to as risk of the environment from March continued to dominate, treasuries outperformed ag, with long duration treasuries being the best performing fixed income in 2020 due to the sharp decline in yields during the first quarter. And treasuries work as we expect a risk management vehicle in our portfolio to hedge risks. And on the equity side, interestingly, you will see from the color scale of the chart on the left that sharp decline of Q1 is shown in red. Strong rebound of Q2 is in green and extended yet slowing recovery of Q3 in yellow. Gold is without any doubt the winner of 2020 so far. So in Q3, market continued advance higher until early September when valuation concerns drove a shift in performance between growth and value, but growth later regained its lead. Large cap continued to dominate small cap. US REITs underperformed during this quarter. And during the September sell-off, international equities generally held up better than US equities. So as we can see here, emerging markets outperformed the US for this quarter. Looking at the recovery curve on the right, China, indicated in green line, was the best performing region, both for the year and for the quarter. Emerging markets in Pacific were almost back where they started the year, while Europe lagged further, which is in gray line, still down 9% as measured by MSCI Europe ETF. So far the numbers has been encouraging during the course of recovery, but there's reasonable concern about the sustainable recovery along the path of uncertainty.